In this video, we continue our discussion on Chapter 7, where last time we went over macro equilibrium in the ADAS model. This time we will go over supply shocks by defining shocks, to then go over a negative and positive supply shock, from which we will conclude with a summary. With this in mind, beginning with some preliminaries, in our discussion of macro equilibrium in the ADAS model, we defined a long-run equilibrium to corresponding to full employment holding. We also defined a short-run equilibrium to designate when full employment did not hold. Additionally, with respect to a short-run equilibrium, we further distinguished if there was the existence of an unemployment gap to let us know that this corresponded to a trough, and if there was the existence of an inflationary gap to let us know if the economy was at a peak. Now what we'd like to do is to determine what causes movements between these possible states, in that movement from a long-run equilibrium to a short-run equilibrium, and more specifically, movement from a long-run equilibrium to a short-run equilibrium that corresponds to a peak, and movement to a short-run equilibrium that corresponds to a trough. Where our answer for this will lie in a change in equilibrium in the ADAS model, which will stem from shocks, where a shock is an unexpected event that alters internal market forces in an economy, in which shocks can be either positive or negative and can occur to either the demand side or the supply side of an economy. Where with this in mind, where we will begin is with supply side shocks. Where supply side shocks are shocks that alter the selling behavior of firms in an economy, which means a change in the short-run aggregate supply curve corresponding to a change in macro equilibrium, where this means that shocks are either positive or negative changes to one of the short-run aggregate supply curve determinants that we encountered when discussing the short-run aggregate supply curve. With this in mind, let us see the effects of a negative and a positive supply shock on an economy in terms of what type of movement it generates and what type of short-run equilibrium it generates as well. With this in mind, we will start with a negative supply shock. So in our example, suppose that we have an economy that's initially in a long-run equilibrium, then it experiences an increase in oil prices, where here oil is used as an input in the production of goods and services. So with oil prices increasing, this is going to make it more expensive for firms to produce their goods and services. So then this is going to be a negative change to the short-run aggregate supply curve, henceforth a negative supply shock. So here the chain of events are: we initially have our economy in a long-run equilibrium. We're starting on a graph on the left. We have our ADAS model, price level on the vertical axis, real GDP on the horizontal axis, downward sloping aggregate demand curve to represent buying behavior of agents in the economy, our short-run aggregate supply curve in red, upward sloping, representing selling behavior of firms in the economy, and our vertical long-run aggregate supply curve representing potential real GDP. This economy is in macro equilibrium at the intersection of short-run aggregate supply and aggregate demand corresponding to point A, where since this also intersects the long-run aggregate supply curve, this means that the economy is producing a real GDP level corresponding to potential real GDP. So in terms of full employment, we know that the unemployment portion of our goal is met. Furthermore, at point A, the price level is P star corresponding to the targeted price level, such that price stability holds. With price stability and potential real GDP produced, this economy is indeed in a long-run equilibrium given that full employment holds. Now what occurs in the following period is that there's the increase in oil prices. With oil increasing in terms of its price point, this makes it more expensive for firms to operate, so this will correspond to a leftward shift in the short-run aggregate supply curve from SRAS in red to SRAS1 in purple. We're holding the price level fixed. This corresponds to leftward movement from point A to point B, where firms are now supplying a Y1 amount of real GDP, while agents are demanding a Y star amount of real GDP, where with supply being less than demand, the economy is now in a shortage state such that it incentivizes firms to raise the prices on their goods and services, which will correspond to an increase in the price level, generating upward movement along the short-run aggregate supply curve and the aggregate demand curve until a new macro equilibrium is achieved, which will correspond to point C, where macro equilibrium here is at the intersection of aggregate demand and short-run aggregate supply 1, in which a Y2 amount of real GDP is being produced. at a price level of P2, where initial insights in terms of the short-run equilibrium, we see that Y2 is to the left of the long-run aggregate supply curve, meaning that there is below potential real GDP being produced in this economy. So this means that this economy has an unemployment gap, or that this point corresponds to a trough. Given that the economy started in a full employment state and went to a trough, then the movement that's being generated here is a contraction. So in terms of business cycles, what we have is the economy starting at point A at a long-run equilibrium. The negative supply shock occurs, generating a contraction to the trough corresponding to point C below potential real GDP. So now that we've identified the movement type a negative supply shock has caused, let us now examine this short-run equilibrium a bit more carefully, where we mentioned it was point C with a Y2 amount of real GDP being produced at the price level P2, where the first thing we observed in the past slide was that an unemployment gap existed, which we know since Y2 is to the left of potential real GDP, where if we took the difference between Y2 and Y star, this would give us a negative number, henceforth why we know that an unemployment gap exists, where in terms of full employment does not hold in this economy due to at least unemployment being a problem, and in terms of identifying if this is a trough or a peak, given that it's an unemployment gap, we know that this short-run equilibrium corresponds to a trough. Furthermore, now looking at the price level of this economy at point C, the price level is P2, which we see is strictly above P star, where if we were to take the difference between the two, this would generate a positive number, which leads us to know that there's been an increase in the price level of this economy, such that there's going to be price stability concerns in terms of price stability not holding. So in terms of this economy, they also have inflation problems. So not only does this economy have an unemployment gap indicating unemployment problems, but also there's price stability concerns. And so unemployment and inflation exist in this economy. And when this occurs, this is referred to as stagflation. And this is a worst case scenario for an economy in that they are not individually dealing with either an unemployment problem or an inflation problem in terms of full employment not holding, but they are dealing with both an unemployment and inflation problem. Now, with this in mind, let us now consider the effects of a positive supply shock as well as what type of movement it generates. Beginning with our story, suppose that we have a long-run equilibrium in an economy in which now we're seeing the opposite case, a decrease in oil prices, where since this is an input used by firms to produce goods and services, with a decrease in oil prices, this will make it cheaper for firms to produce goods and services, which will mean that they will increase what they are supplying, henceforth a positive supply shock, and that we'll see a rightward shift in the short-run aggregate supply curve. Now, in terms of the chain of events, we have our economy initially in a long-run equilibrium as before at point A, the intersection of aggregate demand, short-run aggregate supply, and long-run aggregate supply, leading us to know that potential real GDP is produced. And in terms of the price level, we're at P star, so price stability holds. So we indeed have a long-run equilibrium satisfying full employment in this economy. Now, in the next time period, we have a decrease in oil prices. With a decrease in oil prices, firms find it cheaper to produce goods and services, so this will correspond to a rightward shift in the short-run aggregate supply curve from short-run aggregate supply to short-run aggregate supply 1 in purple. We're holding the price level fixed at P star. This means rightward movement from point A to point B, where at point B, firms are supplying a Y1 amount of real GDP, while agents are demanding a Y star amount of real GDP, with supply being greater than demand. This means that the economy is in a surplus state, such that firms have incentive to decrease the prices on their goods and services, corresponding to a decrease in the price level of the economy, which will generate downward movement along the short-run aggregate supply curve and the aggregate demand curve until a new macro equilibrium has been established at the intersection of aggregate demand and short-run aggregate supply, corresponding to point C, in which a Y2 amount of real GDP is being produced at the price level P2. Where some initial insights is, with respect to the short-run equilibrium, we see that Y2 is to the right of potential real GDP, meaning that this economy has an inflationary gap, where with respect to business cycle phases, this is then going to correspond to a peak. Since this economy initially started in a long-run equilibrium and had movement going towards a peak, then we can say that the positive supply shock generated a recovery to a peak, where in terms of business cycles, then in terms of our graph on the right, this economy started initially at point A at a long-run equilibrium. The positive supply shock occurred, generating a recovery, leading us to the peak at point C, which was that short-run equilibrium with an inflationary gap. So now that we've identified the movement type that a positive supply shock generates, let us now look at the short-run equilibrium a bit more carefully. Where once again, this is going to be point C, intersection of aggregate demand and short-run aggregate supply 1, in which a Y2 amount of real GDP is being produced at the price level P2, where with respect to real GDP that's being produced, we see that Y2 is to the right of potential real GDP Y star, such that if we took the difference between Y2 and Y star, we would generate a positive number, which is what allows us to see that there is an inflationary gap in this economy. And with this inflationary gap, there could be some concerns that unemployment is artificially too low and that it is below that 4 to 6% range. Now, corresponding or now looking at the price level of this economy, we see that with respect to P2, that P2 is strictly below the targeted price level P star, such that if we took the difference between P2 and P star, this would lead us to generate a negative number, indicating that the price level of this economy has decreased, where with a reduction in the price level, this means that disinflation or deflation has occurred and that price stability concerns are not going to be an issue in this economy. So then overall what we have then is what this positive supply shock generated in terms of adjusting to a new short-run equilibrium was an economy producing at a real GDP level that's above potential and facing a more favorable rate of inflation. So in terms of this short-run equilibrium, it is favorable in terms of generating conditions for long-run growth in an economy. So then, now having looked at movement and short-run equilibrium with respect to negative and supply shocks, let us conclude with a summary in terms of what we have found. Shocks are the mechanism that drive movement in business cycles, where with respect to supply shocks, when starting at full employment, negative supply shocks will correspond to contracting to a trough, which will result in stagflation, a worst-case scenario for an economy in that both unemployment and inflation exist, whereas positive supply shocks will correspond to recovering to a peak, which will result in conditions favorable for long-run growth to occur in an economy. With this in mind, where we'll pick up next time is we will go over demand shocks.